In Chapter 7, we're going to be discussing inventory. So there's two main ways to calculate inventory. When I say calculate inventory, I mean how are we going to arrive at the balance that is on the balance sheet at the end of a period? There's two different ways. The first way is the periodic method. The periodic method has us adjusting inventory at the end of the period, the month, the year, whatever period we're looking at. So we don't make any adjustments to our inventory balance, even though we're selling things all month. We don't adjust the balance in inventory until the end of the month or the period. With perpetual inventory, we are adjusting inventory in real time. So think of it like in a grocery store where as soon as your item is scanned at the checkout line, the computer automatically takes it out of the inventory balance. So perpetual inventory is adjusting inventory on a daily basis in real time as things are sold. So we're first going to start off with the periodic method, and there are 4 assumptions that we're going to go through. So we could use 4 cost flow assumptions, and I'm going to go through each one, first for the periodic method, and then each cost flow assumption also then for the perpetual method. So number 1, we have specific identification as our first cost flow assumption. And this is most commonly used at car dealerships because each car has a VIN number, so it can be specifically identified. And so each car costs a different amount, and we will not just take any old car off of the balance sheet. We're going to take the exact car that was sold off the balance sheet. So here's an example. We have 3 cars. Okay, and the customer comes up to the lot, customer buys this car. And this car has a specific VIN number and an exact cost attached to it. So this car cost $12,000 to make. So let's go ahead and put $12,000 in for our cost of our merchandise sold. And each of these cars sells for the same amount. They all sell for $18,000. Okay, so that's our sales price. Well, we sold one car, and so we're going to use the exact cost of that car to arrive at how much our gross profit is. So we grossed $6,000 on the sale of this car. Now what's our ending inventory balance? Well, there are 2 cars left, and together they come up to a balance of $25,500. So our ending inventory is $25,500. So this is what we would do at the end of the month. We would attach the exact cost of the car we sold to the sales price. And the other 2 remaining are our ending inventory. Our second cost flow assumption is called first in, first out. And we commonly abbreviate this as FIFO, and so I'll be referring to it as FIFO, first in, first out. And this is used most commonly to prepare our financial statements. So here we have a list of 3 items that we have in our inventory. So total amount in inventory is 3. And throughout the month, we as a merchandising business, we are buying this inventory throughout the month, and it costs a different amount every time we buy it. And so we want to be thinking about inventory usually will increase in price, but not this rapidly, probably not this rapidly, but over time inventory fluctuates due to demand, due to supply, and so our cost to purchase the inventory can change. So we're assuming here that every time we buy another item, it's a different price when we buy it. So that's why the cost is over here. So the total cost of our inventory for this month was $36. for each of the 3 items. So with the first cost flow assumption of FIFO, let's assume that we sell 1 item in May. We sold 1 item. Well, because we're using FIFO, we're going to assume that the first one that we bought is the first one we sold. Even though we may not know exactly which one it was, they're all sitting on a shelf, and we're just going to assume that it was the first one. So here it says we sold it for $20. And we're going to use the first cost because this is how much it cost us for the first purchase. And so that makes our gross profit $11. Well, then if we sell the first one, that means the last 2 here are our ending inventory. So that's what's left in our balance on our balance sheet, and ending inventory, $27. Our next cost flow assumption is LIFO, or last in, first out. And this is most commonly used for tax purposes. The caveat is if you use this for tax purposes, then the IRS also makes you use it for financial statement purposes. So this makes our tax lower because we get to deduct more. See how it works. So we sell another unit for $20. And we're going to get to the end of the month. We've got 3 units still in inventory, and they cost us a total amount of $36. With LIFO, we're going to assume the last one we purchased on May 24th was the first one we sold. So the last one bought, first one sold. So that one cost us $14. So our gross profit is $6. And that leaves our ending inventory with the first ones that we bought. So $21. $22. The first 2 here. Okay, so you see the difference. For financial statement purposes, we want our investors to see that we have big income. So FIFO makes our income larger. You see, because we, in a period of rising prices, the first one we buy should be the cheapest. So down for tax purposes using LIFO, also in a period of rising prices, the last one we buy should be the most expensive. So this actually makes our income the smallest, which is what we want when we're filing our taxes. We want our income to be low, so we will pay less taxes. So that's why we have 2 different assumptions here for financial and tax purposes. The last cost flow assumption is weighted average cost. So what we're going to do is we have a formula here where we take the weighted total cost divided by number of units. So the first thing that we have to do is get a weighted total. And this is going to be pretty easy because each level of cost here has only 1 unit. So we've got 1 unit at each level. But it could be, it could be 10 here or 100 here, or maybe even 1,000 here. And then your weighted average would be different. So let's just assume that we have 1 unit in each level. So you're going to multiply out to get your weighted total. Across. So 1 times 9 is 9. 1 times 13. 1 times 14. So our weighted total is 36. Now if you had different number of units at each level, like I said, your weighted total would be a bigger number. So that's going to be your numerator, $36. And your total number of units is going to be your denominator, or 3. So that means our average is $12 each. So we're going to use $12 every time we sell something for our end of the month. So let's say we sold one, again for $20. We're going to use 12, our weighted average, as our cost of merchandise sold. This makes our gross profit 8. We're also going to use weighted average for our ending inventory. So there are 2 units in ending inventory, and each is going to be 12. So that makes our ending inventory 24. So those are the 4 cost flow assumptions, all for the periodic method. Now let's move forward and do the perpetual method. So there are also 4 cost flow assumptions that we're going to use for the perpetual method. And the first specific identification works the exact same. So let's focus on FIFO. FIFO is first in, first out. So what we're going to do is, here are the transactions that happen during the month, and let's work out a table of what happens in real time. So we have to adjust our inventory every time we make a sale, so we're going to do it in real time. So starting off with beginning inventory. So this first row here shows that we have 1,000 units that cost $20. So I like to just pretend like this last column is our shelf, where our inventory is. And the shelf is going to have multiple layers because costs are different. So beginning balance, 1,000 units at $20. And we don't have to worry about multiplying it out until the very end. On January 4th, we sold 700 units for $30. So we don't have to worry about the sales price just yet, but we did sell 700 units. So the middle column is going to be our cost of merchandise sold calculation. But we need to know, at what cost were they? Well, we only have one layer, and it was $20. So we sold these at $20. We only had one layer to choose from. Now we don't have $1,000 on the shelf anymore because we sold 700 of them. So now we need to fix. We have 300 now on the shelf at $20. On January 10th, we purchased another lot of inventory. We purchased 500 units right here, and they cost us $22.40. So now we have 2 layers on the shelf. The first layer that we bought at $20 and the second layer that we bought at $22.40. So then we have another sale on January 22nd. We sold 360. Okay, well, if we are using FIFO here, we're going to sell the first shelf first. So our first shelf only has 300 on it, and they were at $20. So how many more do we need to sell to get to 360? Well, we got to sell 60 more because we sold 360 in all. So we sold all of these. We got to sell the next 60 from the next shelf at $22.40. So if we sold 60 of these, then we have 440 left, and they're all at the $22.40. Okay? Now, on the 28th, we sold 240 more. Well, we only have one layer to choose from, the 440. So all of those are going to be sold at $22.40. If we sold 2240 of these, that means we have 200 left, still at $22.40. And then on the last day of the month, we purchased 600 more at $23.30. Okay, so I think that's all our sales and all our purchases. So now we can total everything up. So let's start with ending inventory. Well, if you're keeping up with crossing everything out as you sell it, right here, the 200 layer and the 800 layer should be our ending inventory. So we have 800 units left in ending inventory. And if we multiply them out, let's see, 200 times 2240 is 4480, and 600 times 2330 is 13980. So our total ending inventory balance is 18460. Okay, now let's come up with what is cost of merchandise sold. Okay, well, we have to multiply them all out. 700 times 20 is 14,000. 300 times 20 is 6,000. 60 times 2240 is 1344. And then 240 times 2240 is 5376. So all four of these totals together is going to be our total cost of merchandise sold of $26,720. Okay, so now we can calculate our gross profit. We had 3 times we had to sell. We sold them all for $30. And let's see, we sold 700 units, 360, and 240. That means that we sold 1,300 units at $30. So our sale will be $39,000. So 13,000 units times $30 selling to a customer. We bought them for cost of merchandise sold, which is $26,720. So our gross profit is $12,280. So there are 3 main things that I'm going to want to know when you're doing inventory. It's what's gross profit, what's cost of merchandise sold, and what's ending inventory. And this is going to be the important information whether we're using periodic or perpetual. So let's do another one. Let's do LIFO. Now this is the same, these are the same inventory transactions from January 1 through January 30, but this time we're going to use last in, first out, and you'll see how it changes those 3 main answers. It'll change our gross profit, it'll change our cost of merchandise sold, and it'll also change our ending inventory. Okay, so we're going to start off with our 1,000 units in beginning inventory. And on January 4th, we sold 700 units. We only have 1 layer to choose from, so we're going to sell those at $20. That's the only shelf we have. So now let's take $700 off the shelf. We only have 300 left on the shelf. Okay, and then on January 10th, we purchased 500 more. So now we have a 300 units on a shelf at $20 and 500 units on a shelf at $22.40. Okay, and then on the 22nd, we sell 360. Well, the first 360, since we're using last in, first out, we can pull all of those off of one shelf because we're going to pull them from the last shelf first. So all 360 can come off of one shelf, and we're going to pull them at the higher cost, last in, and they're all at $22.40. So now we have, we don't have 500 anymore. We have 300 at 20, and we have 140 left at $22.40. So you can cross those off. Now here is what we have after that sale. Okay, and then we have another sale on January 28th. We sold 240. Well, if we go from the last shelf first, we can only sell 140 of those at $22.40, and those are gone. But we need 100 more because we need to sell 240. So we're going to get the other 100 from the 300 shelf last. Okay, so now we only have, so we sold all of these, we sold 100 of these, so we have 200 left of the $20 layer or shelf. Okay, and then the last thing we do is we purchase 600 more at $23.30. So we can start with ending inventory again. All right, we're going to multiply out 200 times 20, 600 times $23.30, and that works out to be, when you add them together, $17,980. That's our ending inventory. Next thing I want to know is, what's my cost of merchandise sold? Well, you multiply 700 times 20, 360 times 2240, 140 times 2240, and 100 times 20. And then you add them all together, your cost of merchandise sold should be $27,200. So that's what we're going to plug in to our cost of merchandise sold. And our sales amount is actually the same because we've sold 1,300 units for $30 each. So that's still $39,000. And so our gross profit is going to be $11,800, which is lower than when we did FIFO at $12,280. So that's what we would expect. We would expect the LIFO gross profit to be lower than the FIFO gross profit. That's because cost of merchandise sold is lower for FIFO than the cost of merchandise sold for LIFO. LIFO's cost is higher. That is why gross profit is lower. So these are the little nuances that you need to know about what the differences will turn out to be if using LIFO or FIFO. Now, I know there's a fourth cost flow assumption, weighted average, but I'm not going to ask you to do weighted average cost flow assumption for the perpetual method. But I do want you to know LIFO and FIFO when we're using the perpetual method. So this should help you with your homework, and good luck. Let me know if you have questions.